Hi, everybody. Joe Pizar here with my partners, Melissa and Josh Stein here. Welcome to Finance in 15. It's March 2024, and there has been a lot going on in the economic world. So we wanted to bring you the leading indexes and what's going on in the major markets, what's going on with some of the major indicators, major economic data points, and then the implications for you, the investor, and what you might want to be watching out as you work with your financial planning team. So, Josh, there's been a ton going on since we spoke last. What are the main things you're seeing jump out at you, and what do you want to talk about later on?
Sure, thanks, Joe. Well, a lot of what has been going on has been really a lot of the same things that have been going on for really the last 2 years. We've kind of gone through this massive financial transition from really having no idea about what's going to happen with inflation and interest rates to knowing what's going on with inflation and interest rates, both of them going up, causing quite a bit of market turmoil. And then a lot of anticipation about what's next and some Fed volatility with regards to whether or not they're going to continue raising rates, stop raising rates, maybe even lowering rates, to a point today, to answer your question of, I think we actually have a lot more clarity than we've had in a long time. The reality is most of the economic volatility has been driven from the same data points and the same issues that we've discussed over and over again. Inflation, interest rates, and ultimately economic productivity, let's call that maybe a recession or not, corporate profitability, and mostly waiting to see what happens, unfortunately, and we'll talk about this in a little bit in terms of the impacts of an election, but unfortunately, we've had to put a lot of faith and resiliency into how the Fed handles our situation, and most of what we've seen has been a result of Fed policy. We'll see, I think, the fruits of that this year, hopefully, because for better or for worse, maybe even a lot of for worse, there's been action and inaction that maybe wasn't optimal. But here we are today, March of 2024. Things are a lot better than they were last year and significantly better than they were 2 years ago.
And actually, Josh, I'm really glad that you said that because I know that we feel that way, but I think in general, there is still a lot of negativity out there. I think that's being driven by just general feelings of, there's been turmoil financially over the last 4 years between global pandemic, supply chain damage, inflation. It hit a lot of people's bottom lines. It feels really bad when those things are happening. Also the general, misinformation that's just provided out there sometimes. But when we actually take a look at the indexes over the last year, the S&P 500, which is, our largest stocks in the U.S. is up over 28%. Bonds are starting to head towards recovery, and we're going to talk more about that, up over 4%. Even international stocks, even with all the geopolitical things that are happening, are up over 15%. And I think that, as Josh said, we're in a much better place today and have a lot more clarity than we've had in a long time. I do think that people are feeling negative about the election and the uncertainties around that. But we know that there's absolutely no data to show that a presidential election is going to drive the financial markets. We know that bad policy over a long time can affect GDP growth and economic growth, and therefore maybe even eventually profitability. But it's only one piece of what can affect the stock market. And we're not saying a presidential election isn't important. It is, but it's not going to drive the stock market as much as a lot of people think. There are many other factors like Fed policy, interest rates, overall, productivity and profitability in companies. One of the things, and I repeat this a lot in these, is I think it's important to recognize that the stock market goes up when companies are making more profit. If we're in a position for companies to make more profit, then the stock market is probably going to go up. If we have policies and or are in a situation where we're in where companies are not in a better position to do that, it's probably going to go down. And right now, I think we have a lot more clarity, as you said, around where we're at today than we have had in a long time. And it's created some opportunities. These situations always create opportunities in the market, and those are some of the things that we're looking for right now. Josh, you want to talk a little bit about the fixed income market, because it just doesn't get a lot of attention as compared to like the stock market.
Well, for the longest time, it was completely irrelevant. We've been in such a low interest rate environment up until a couple years ago. We were really coming out of '08, where bonds were probably the most boring investment you could ever buy, because they were stable in terms of their price fluctuation and the interest rates were extremely low. Looking before we got into this inflation mess, a treasury bill was paying you 0.0x%, let's call it nothing, and a 2-year treasury was barely paying over 1. So they were really almost irrelevant from an income perspective. And so nobody talked about them, right? We still use them as advisors, mostly to diversify risk across asset classes and to get some non-correlation to stocks, but not really as an opportunity necessarily. For the better, that's changed a lot, because we now have multiple areas of opportunity in bonds. Obviously, the biggest one is just that they're paying interest, right? So you can see that. You go to the local bank and there's CDs at 5%. You go to your money market accounts, they're actually paying interest as well. Bonds also, and arguably more favorable than other banking type of products. But if you can generate yield and generate income using bonds at a significantly less risk than the stock market, for people who are interested in income, that's a huge opportunity. The other thing is this concept called duration. I think we've spoken about this maybe in other topics that we've talked about. Again, duration was something nobody paid any attention to because it was completely irrelevant. But think of duration as the economic value of time in a bond. So if I own a bond and it's a 10-year bond, that company is paying me that interest over a 10-year period of time. Depending on where rates are, there could be a value to duration. Now, we saw the exact opposite of that when rates were going up. So as the Fed was raising rates, bond prices were crashing, right? Well, the opposite is true as well, which is if we get to a point where the Fed starts to lower rates and it looks like we're knocking on that door, then we should get paid to own duration, meaning if we have a bond that will pay us a higher interest rate than we can get on the open market for a period of time, there's value in that, and we should see those bond prices rise. So not only are we in an opportunity if we pick the right bonds, because it's actually not easy to generate income today with an opportunity for appreciation, for like actual price appreciation, where you can make a profit by owning that bond tomorrow for a fraction of the risk of the stock market. To me, that's a great investment.
Those are all really great comments, Josh. I mean, it always surprises me how little attention the bond or fixed income market gets compared to the stock market.
So nobody cared.
Right. Well, so most of our clients have somewhere around 30 or 40% in bonds in their portfolio. And the purpose of them is to diversify the portfolio, combat equity risk, provide stability and income. This really is the first time in probably 15 years that you can get any decent yield on bonds. Yeah. So this whole resetting of asset classes in 2022 has actually provided us like a situation where, or has created a situation where we have more opportunity in fixed income than ever. It also means that bonds in your portfolio, it also means that we can build portfolios that actually have a bond piece that are likely more stable, and we can expect to get more yield from them moving forward in this more normal interest rate environment.
Still have to be very careful about what bonds you pick. There's a lot of ways to mess up still. Just like if you don't know anything about stocks, there's a lot of good stocks and there's a lot of not so good stocks. How do you know which ones to pick? Bonds, from that perspective, are the same.
But even looking at portfolios as a whole, bonds are almost as important, especially for our retired clients or clients nearing retirement, as the stock piece, but they tend to not get a lot of attention. And it's actually more difficult to manage bonds, and you need more skill as a money manager to understand bonds and the interest rate environment and navigate that than you do to navigate the stock market. So that's an area that a lot of our clients seem to actually forget about, but we are very focused on that right now. There's a lot of opportunity in bonds that have been created. And just to kind of like sum up what that is, I mean, just in very simple terms, for those of us who are like, well, the word duration kind of makes your eyes go like this. When basically interest rates come down, and we expect them to over the next year, not only are you getting yield on that bond, but it can also create price appreciation. So, bonds reset in 2022. They went down 13%. They started to recover last year. They haven't realized that full potential. There's absolutely continued potential in this. It's not getting a lot of attention. And for the first time in 20 years, this interest rate environment has opened up the opportunity for other type of higher yielding vehicles like money markets, CDs, things that really haven't been used for a long time because you were basically safely losing your money.
Mm-hmm. Still have to be careful with those. If we do get into the point where the Fed starts to lower rates,
Right.
Those are going to be the first instruments that drop because they have actually zero duration.
But these are all opportunities. And I have been talking about this in the sense of I feel like 2024 is going to be a transition to sort of the great normalization. After 2008 and 9, the Fed started doing some different things with the interest rates, keeping them very, very low, something we've never seen happen historically for a long period of time, basically up until the pandemic. Then we had the pandemic, we had government stimulus, we had basically loose monetary policy from the Fed, interest rates dropping to zero, flooding the money supply chain damage. My favorite economist said we weren't going to start to feel normal until 2024, and I think he's absolutely right. Although a lot of us don't feel like anything's normal because of the election, but the truth is the economy and the stock market are likely going to behave more normal than they have in a really long time. And we're excited about that.
Let's talk about that for a minute. Why does everybody feel like nothing's normal when we may be knocking on the first phase of normalcy in a while?
I think it's an important thing to remember that we've gone through some serious collective trauma. COVID was the most traumatic event that many of us have experienced in our entire life, with the exception of the few people still around that went through World War II. And that disruption was supply chain disruption, isolation, and all that.
Well, and then there's the political,
Right.
contention and the geopolitical things.
So-
I think there's sort of a lens that we're all looking through of negativity, and I think it takes time for that feeling to kind of melt away. But what we always talk about is separating the facts from the narrative, right? Mm-hmm. We focus on data and facts. We know that these things are true, but investing your money and looking at these things is very emotional for people, so we just tend to have a different lens on when we're looking through that, which is why oftentimes when people are feeling the best about the stock market is when we're the most fearful, because we know there's probably the most risk out there, versus now where everyone's feeling very negative. This could be a great entry point, or there could be a lot of opportunities right now. Usually there's less risk when things feel bad. And at least in our in our experience, that's what we've seen. But because of the emotionality of investing and how our brains work as investors, we don't see that unless we really cut through all of that narrative and the media messaging and look at the real data. And that's why we're here to help our clients. We can be more objective about their money. It's just easier.
To me, it feels a lot like The Boy Who Cried Wolf. And the media loves to cry wolf. And that's what is shoved down most people's news feeds, data feeds, Twitter feeds, newspapers. There's always a wolf. At the end of the day, there will never be a time where there are no problems. But has there been a point where all the sheep get eaten? No. Life goes on, the markets go on, things ebb, things flow. And at the end of the day, most of economics and most of stock market investing is really the same.
Yeah, I think a lot of things happening feel very catastrophic to people right now. But if you look back through our history, and there are many, many points in time where there were things happening that were probably a lot worse than are happening now. Different periods in time. Look at World War II. What was happening to our country then? Look at the late 60s, early 70s. There were riots all over the country. We had presidents getting shot. We had a Cold War and the threat of nuclear war. I think a lot of things going on today are negative, but when I look at the magnitude of what people were dealing with then and now, and our economy and our country and our stock market, they always do. They are resilient and it adapts. And we adapt, and that's one of the greatest things about being here is we have the opportunity to be able to do that. So yes, everything's not perfect, but I think overall when we look at this, we are looking at it through a lens of there are opportunities. There's always opportunities, and And often the opportunities come when there's a lot of, I think turmoil and uncertainty. And we do feel like this year is going to be a transition to more normal, and that is going to feel better. It's just going to take some time. And I think once the election's over, people will realize that, we just have to sort of figure out what's happening then, and adjust and move on. And
So scale of 1 to 10, importance of an election on the economy. What's your call?
Do I have to give a number? Maybe 0 or 1?
Okay, 0 or 1.
Very, very.
I mean, I think it matters if it drives like significant like changes in policy that could be. But I mean, so I'll give it a 3. But like also, I don't think the policy's been great for the last basically almost 2 decades, and we've been bumping along at a 2.5% GDP growth rate to 3% growth rate. So I think already we've had some policies that aren't great. So I don't think it's getting any worse. I think we're working towards hopefully getting to something better.
Yeah, I'm going to give it a 3 only because I think that anytime that there's enough media noise, there can be some jitters. Go watch Chairman Powell, because ultimately he has been and will continue to drive the overall volatility or lack
He's going to have a bigger impact on the economy than that.
So watch what he says, and he's already one making policy, and he will have more influence over the next 24 months than any presidential
So
election.
Fed policy decision is likely more important than presidential election in this situation.
No doubt.
There's other issues.
All right. So to recap, thank you, everybody. Thank you for the comments and all the good conversation here on Finance in 15 for this one. Let's go through our key takeaways, right? Things are not as bad as they seem, right? Melissa, to your point, it is nowhere near as bad as it seems. And in fact, we've had quite a few improving economic data points. And Josh, to your point, we are knocking on the door of normalcy. I think that Chairman Powell and the rest of the FOMC have made many points to show that the economy is hopefully working toward a soft landing. We saw that through multiple sectors, right? And then I think a great point is that the Fed is more important than the presidential election. They are setting the policy for how much debt we issue and what those Fed funds rates are, and that is going to drive a lot more in the economy than this shark noise in the next couple of weeks. So
More to come on that in another video, right?
Yeah. I think join us next time to hear more about these geopolitical tensions, this election, and this
Importance of Fed policy.
and the Fed policy. So very good points, and thank you. So with that, we appreciate your time today, and thank you for joining us, and we'll see you at the next Finance in 15.
Thank you.
Thanks.